Welcome to today's hot topic, the sudden surge in the popularity of gold as a long-term investment option. Recent times have seen a seismic shift in American investment preferences. A recent Gallup poll has brought to light some intriguing trends. Economic insecurities and a downturn in housing markets have paved a golden path, leading investors to consider gold as a more attractive long-term investment than stocks. This is a noteworthy change, the likes of which we haven't seen in a decade. Gold, once a sidelined asset, has now surpassed stocks, taking second place in the race for the best long-term investment. Amidst this gold rush, it's crucial to remember that all that glitters may not be gold. So before you start panning for your golden fortune, let's delve deeper into the matter. Despite its newfound popularity, gold appears to be underperforming as a safe haven asset. It's not the bright, shiny prospect some might imagine. Why, you may ask? Well, the overvaluation of gold is a significant factor. This has been driven by a robust US dollar and competition from high bond yields. Economic blogger Scott Granis offers an interesting perspective on this. He suggests that gold is expensive when adjusted for inflation. Until interest rates decrease significantly, there seems to be little incentive for investors to buy gold at its current prices. This means that, as it stands, gold might not be the glittering investment opportunity it's often made out to be. Now let's talk about the spread between gold and Treasury inflation-protected securities, or TIPS, as they're commonly known. This spread indicates that gold prices could further decline before attracting those bargain-hunting investors. So, those seeking a gold rush might find themselves waiting in the wings for a while longer. But there's another wrinkle to consider. Gold has already priced in future increases in US inflation. This means that much of the potential gain from inflation hedging is already accounted for in the current price. In other words, the golden ticket has already been punched, and latecomers may find themselves paying a premium for a ride that's already well underway. So before you strike gold, it seems like there are a few nuggets of caution to consider. It's important to dig deeper and look beyond the surface, because as we all know, not all that glitters is gold. But there's always another side to the coin, isn't there? As the pendulum swings, we see a positive outlook on the stock market, despite the prevailing sentiment. It's a curious phenomenon, but history has shown us a trend. When the crowd is bearish on stocks, it tends to be a good time to be bullish. It's as if the market has a mind of its own, thriving on unpredictability and defying expectations. A contrarian approach can often catch the tide at its turn. Let's consider the stance of State Street Global Advisors. This passive investment titan has trimmed its exposure to global equities, shifting instead towards safe haven assets like bonds and, you guessed it, gold. Their strategy clearly indicates a hedge against potential risks, such as rising inflation and interest rates. But it's not all gloom and doom. The firm still has a soft spot for growth-sensitive assets like equities, credit, and commodities. Yet their move towards gold and bonds sends a powerful message. It's a defensive play, a protective stance against potential market shocks. The market, they believe, is vulnerable due to complacency. And in such a scenario, gold, with its reputation as a reliable store of value, comes into the spotlight. State Street Global Advisors' strategy also reveals an interesting perspective on the US market. They expect the trend of US market outperformance to diminish as the growth differential between the United States and Europe narrows, and emerging markets make headway against the COVID-19 threat. In such a climate, gold appears to be a strategic move, offering a safety net against potential turbulence. So here we are, caught in the crosshairs of contrasting views. On one hand, we have a positive outlook on the stock market, suggesting it might be a good time to be bullish. On the other hand, we see a shift towards gold, a defensive play against potential market instability. The scales seem to be tipping in favor of gold, but are they really? Let's delve deeper into this in our next segment. So, is gold the golden ticket to long-term investment success? We've seen a flurry of evidence, opinions, and perspectives. On one hand, there's the allure of gold's historical prestige and its recent surge in popularity among Americans. It's been touted as a safe haven, a shield against inflation, and a hedge against geopolitical uncertainty. However, on the flip side, we've also heard concerns about gold's underperformance despite current turmoil, its overvaluation driven by a strong US dollar, and competition from high bond yields. Some argue that gold has already priced in future inflation increases, and that its prices may further decline before luring in bargain hunters. So, where does that leave us? In the realm of investing, there's rarely a one-size-fits-all solution. It's crucial for each investor to consider their individual circumstances, financial goals, and risk tolerance. Weigh the pros and cons. Understand that every investment comes with its own set of risks and rewards. The truth is, there's no one-size-fits-all answer. But one thing's for sure, it never hurts to stay informed. Before we wrap up today's discussion on gold as a long-term buy, let's not forget our little ritual. Make sure you've subscribed to our channel for more in-depth investment discussions, and don't be shy to share your thoughts in the comments section. Remember, your golden opportunity to stay updated on the latest financial news is just a click away. Subscribe and join the conversation now.